Disappointing dollar sales on price cuts in the EU, which means they had to lower the price. Changes in foreign exchange rate. One of the biggest issues with the dollar becoming more expensive as we move the products overseas. They're more expensive for our customers to buy, which means they lower sales, increase trade discounts. So the total volume sold increased 14.6% year to year. Net revenues were up 2.2% year to year, primarily driven by the jerky, while new revenues in the U.S. food service channel dropped negative 2.4%. International net revenue slumped negative 70% due to list price reductions in the EU, unfavorable foreign exchange rate impact, trade discounts, while international food service net revenues rose 0.7%. Okay, now we go to Beyond Meat. They got a credit facility. This is in 2020, right? They got a $150 million 5-year revolving credit facility to support its future growth initiatives. The new credit facility includes an accordion feature for up to $200 million. But I want you to look at something. In 2020, the cost of capital was very, very cheap, right? So they have access to capital in 2020, $150 million up to $200 million, right? But at that time, the cost of capital was very, very inexpensive. So we know that they're burning through capital. They do have a credit line that they were able to access in 2020, but it's very likely they run out of money because they're going to need more than that $200 million of credit line to keep this going because they're losing money on every sale. Okay, let's go into the next one. Here's their statistics. Okay, let's go into profit margin, negative 71%, operating margin, negative 65%, return on assets, negative 14%, return on equity, negative 320%. Let's not even go into revenue. Total cash at this time, $454 million. Total debt, $1.16 billion. Operating cash flow, negative $416 million. Levered free cash flow, negative $327 million. So at this moment, he said that they had $548 million in cash, but as of right now, we're showing that they got $454 million in cash. So they're still burning through cash. This company is going to run out of money, right? And they'll probably run out of money before the end of next year. They're going to run out of money. And then where are they going to locate new capital from? And in this new environment, the cost of capital is going to be a lot more expensive, right? Let's go to Morningstar, looking at the financial statements. So we have revenue, net income. We have revenue in the blue, net income's in the red. What do we see? Good revenue, very low net income, right? So we already know that this company's driving revenue, but there's not a lot of profitability there. We go to the balance sheet. We go to the cash flows, operating, investing, and financing. We go to annual revenue from Seeking Alpha, and we see here they're missing all their earnings, right? So here's the consensus. Here's the actual. They keep missing. They keep missing. They keep missing. They keep missing. So we lower expectations, but we keep missing, right? We go here. We also see the earnings. We also see the revenue right here. Something else I wanted to show you. Let me go here. Let me go to the financials real quick. Okay, what I wanted to show you is that as revenue goes up, the cost goes up. So the operating expense goes up. So what we're showing is that as we continue to make more revenue, the cost goes up, but we're in the manufacturing business. Now we do have some, distribution, things of that nature, but primarily their business is to make these products, right? They're just not the marketer or the distributor of the products. They actually make the product. When I'm looking at manufacturing, what I want to see is that as we scale, the cost goes down. We hit economies of scale. Manufacturing costs go down because what margins are we looking for? What margins are going to be acceptable in our manufacturing business? So if we go back to the actual margins, right, we're very much in the negative, right? The margins are very much negative. So what margin is going to be acceptable? So the issue is that how do we even get this margin to be positive? What's the path to profitability where we can get a 15 to 20% margin on what we're doing? Because if we can't get that, should we even be in this business? Would our capital be better used somewhere else? Now, it's going to be case-by-case scenario. Grocery business does very low margin, but they do a lot of volume. But if we're in the manufacturing business, what margins are acceptable, right? But we're at negative 71% profit margin. We're at negative 65.18% operating margin. How do we get those margins positive to where we're not just throwing our money into a fire? So when you look at this, if you start to recognize this early on, you just continue to observe it. You see the trade is where this company's going to go bankrupt, especially in this type of regime monetarily. So then what do? I play them to go bankrupt, right? I just play them to go bankrupt. I can teach. So once I get a whiff of something like this, then what I do is I put them down on a piece of paper and I just continue to observe them. And I continue to observe them. I continue to observe them. And then I think about, well, when's their next earnings? What do I think that earnings is going to be? And then I start to figure out what is my narrative to try to play this. So I get a feeler on this company, then I just keep observing it, observing it, observing it, observing it, and continue to watch their financials, look at their 10Qs, look at anything that they may release, and determine, are they still just bleeding through all their money? And then I start to set myself up for it. But one of the easiest ways I find trades is I look for companies that are negative cash flow. Wayfair, Carvana, Freshpet, this company, even Netflix. Quad has kept Netflix over 5 years is negative free cash flow. And I don't think they make it because of the costs associated with running their business. And I think they're in a race to the bottom. But they're negative free cash flow. Disney's not. If Disney was to separate their streaming business, they wouldn't be negative free cash flow in that streaming business. And so you got to understand is that you want to start looking for trades and looking for opportunity before it becomes obvious to the rest of the world. That's why I wanted to show you the video. But like I said, I can't control that. Right? YouTube is kind of funny about what they allow you to show. But you got to start looking at things before it's obvious to the rest of the world. And then you got to move past just talking about it and being a philosopher of it and being somebody that can actually take action on it. Are you going to be right all the time? No. But you can paper trade your analysis. Therefore, if you believe something about a particular company, just paper trade it. And then what you're doing is you're starting to test your analysis ability. But you're never going to be successful if you're an expert on, you got the guy in poker that after all the cards is played, he knows what everybody should have done. But the cards are already they're already out of everybody's hand now. So of course you're an expert at it. The people that make money in poker is the people that can sit at the table and they know how to put the cards down in the game. The people that sit on the sideline and they say, well, he should have played this, he should have played that. They don't make any money. And that's what I want you to understand. You can test your analysis by paper trading it. Create your narrative, create your analysis, paper trade it, find out whether or not you're right. Things can happen within a trade. I'm looking at Freshpet. They got a activist investor bought that company. I don't think it's going to help them. The activist investor thinks they can help turn the company around. I don't think they can. I think their operations and their management is so bad. Unless that activist investor clears out their board and clears out management, I don't think they got a chance in the world. Right? So things can change around a company. However, I want to encourage you to start looking at things from the perspective of a trader, understand how to actually create analysis around it, understand you're going to make mistakes, move through your mistakes, keep going, but get out of the space of I'm a philosopher, I'm an expert after the fact, and actually get in the game and start doing something, right? And paper trading is in the game. I paper trade now, even though I run a live account. But I want to encourage you to get in the game and start doing something, right? Actually start getting involved in the practice of finding opportunity and finding trades in the market. So if you got any questions, let me know. We're going to go through the comments. We're going to get up on out of here. Let me go here. So Katrina says you don't want to run out of money, especially in the credit crunch. Definitely. You don't want to run out of money because the cost of getting more money can be very expensive, right? So Katrina says the airlines have this issue. Labor costs and fuel costs are higher and people are running out of money. Yeah, definitely. And I haven't seen the airlines earnings, but I want to see what their earnings are going to be and how they're going to deal with fuel costs also as we go into the future. I know they hedge some of their fuel. They have people that trade fuel for them so they can try to hedge it. But if we go into like a long-term issue with fuel costs going up, want to see how long Biden can continue to hit that strategic oil reserve and get money out. Get oil out into the market because it's really about perception. I don't really think that's doing a big deal for oil, but I just think it's the perception that there's more oil on the actual market. I want to see how long he can pull that off. So LRT, man, I appreciate it. I'm glad you get some value from it. Doom, doom, doom. So Urban Home says, how you find your negative free cash flow companies? What I really do is I really find them on Yahoo, but you may be able to find them on FinViz. So FinViz may have a lookup for cash flows. But I usually just find them on Yahoo. I look at a particular company and I just go to their statistics and try to see whether or not they negative free cash flow. Also, you can look at it in Morningstar. But I look for I can kind of tell when I'm looking at a company, kind of based on how they're communicating. Beyond Meat was one, whether or not they actually have a real business. And then usually most of the companies that are negative free cash flow, they don't really have a real business. They have an idea, but they don't have a real business yet. But then sometimes you can have companies that got a real business. They might be like in the energy space where they might be negative from free cash flow because some companies that are in the energy space, they got to spend a lot of money to make the money. They're very CapEx extensive, but they're hoping to hit that big oil well, and that's going to pay all the bills off. So it's a boom or bust environment, but that's going to be very industry specific. Something like Beyond Meat, it's just a manufacturing business. Them being negative free cash flows in 2018 meant that they really didn't have a real business. What they were going to do was just keep using people's money to search for a business. And then once they was able to find like what is the product that people are going to really take to, then they were going to kind of sink all their resources into that. And that's why they kept launching all those SKUs. They had the chicken nuggets. They was in Mickey D's. Mickey D's already had a vegan burger years ago. Most people not gonna remember, but they had one. I think it was called the Arch Deluxe. Didn't work because nobody's going to McDonald's to eat vegan. They're just not. So that's the issue. L license and paper trading Exxon now. So Urban Home says negative free cash flow more important than overall debt load. It depends. So both to me are very negative, right? Because it means you got a negative cash flow, which means you're really not profitable, and you got a certain amount of debt. So it's kind of case by case scenario. But to me, when I'm looking at a negative free cash flow, what I'm showing is that there's no profits. So it means they got to keep either taking on more and more money, where they do an equity raise, they get a line of credit, they do a bond, they do senior debt. They got to do something to keep bringing more and more money in that company, right? Because they're not profitable, which can increase their debt load. If, like I said, if they do some type of not equity raise, but if they do a line of credit or something of that nature, it can increase their debt load. Or if they do a bond, which means they got to service that particular bond, which to me is a form of debt. But I'm really looking at how come this company doesn't have any profit left at the end of the day. So is it that the management really doesn't know how to structure operations? Is what they're trying to do very difficult to actually become profitable at? And then how much runway do we want to give them before we start to believe they can't figure it out? Because one thing I listened to the Tesla earning call last night. Well, they've been able to get their profitability up, to get their margin ups. Now, Elon said our margins are going to be challenged in 2023. But for a very long time, they were negative margin of profit. Then they were able to get a little bit of margin there. They were able to increase that. Elon knows I got to figure out how to scale, but at least keep margin consistent. If I scale and margin goes down, people are not going to like that. And that's a big problem because I still see Tesla as a boutique car maker, right? They want to be at the level of a Toyota. Toyota sells millions of cars, but Toyota got a smaller margin than Tesla. So they got to figure that out. To me, Tesla's a Ferrari. They're a boutique car maker. They don't want to be Ferrari. They want to be Toyota on the EV space. So that's just the issue is how do we get that profitability up, but at the same time increase operations, but don't have expenses eat up everything while we're increasing operations. And if we have to do it, how do we get away from it? Reason why I was bearish on Uber. Uber doesn't really make any money. They just burn money, right? They just burn a lot of money, but they're able to keep getting money to burn up. So I said that they're going to be good until people get dissatisfied with them. Same thing with DoorDash. DoorDash doesn't make any money; they just burn money, right? As they increase operations, they burn through more money. They're not profitable because how do they make more money? They got to either raise the cost of you getting the service, or they got to take more money away from the restaurants or the people that drive. There's really no value in what they do that allows them to really charge more, right? Because there's a limit to how much somebody's going to pay to get food delivered. So those are the kind of things I look at. But I'm a big fan of looking at negative free cash flow, especially over an extended period of time. When we looked at Carvana, they had 1/4 of profitability in the history of the company, right? 1/4 of profitability in the history of the company. But they were able to keep getting cash put into that company. And they just got some more cash not too long ago. That's a great question. Yeah, definitely look at that business model and how it works in the current environment, right? But once we go back to an easy money policy and it eventually will happen, you're going to see companies like Beyond Meat get launched all over again. Why? Because it's easy to get money. And when money's easy to get, people are desperate to get yield, right? Yields are high now because it's hard to get money. When money's easy to get, people are desperate to get yield, which means they really take more risk to get yield. But most people think it would be the opposite. Now people are sitting on their money and they're not willing to take as much risk. When money's easy to get, they're willing to take more risk because it's so easy to get capital. So money doesn't really return anything. So operations is important. Bad operations bleed to mess with the profit margins. So most traditional OEM have tremendous debt burden. Toyota, but yeah, Toyota owes, I think they go like $1 trillion. But we know they're going to sell the cars though, Urban Homesteader. So we know they're going to sell the cars. And the thing about Toyota is they really led the way in lean manufacturing, right? And so that's the issue, is that people are willing to accept, and even though Toyota's trading volume is almost non-existent on the daily, but people are willing to accept what's going on with Toyota because of their volume. And they led the way in lean manufacturing. But I think, and I'm not 100% sure, I believe that Tesla has a higher margin of profit than Toyota. But if Tesla tries to scale to Toyota's level, they may have to take on a lot of debt, and that margin may have to go down. Tesla's right now, their margin looks decent, but they're not at a scale even comparable to a Toyota or a Honda or a Ford. And so these are the things that people got to look at. But like I said, to me, Tesla's a boutique car maker. They're like Ferrari, but they don't want to be like Ferrari. They want to be on the Toyota level, but that's going to come with a lot of issues when you, especially in all those different markets, because one of the biggest issues that they're having now is as the dollar goes up, it makes their car more expensive. I was talking to a guy today on Facebook. He says that they're going to come up with an affordable vehicle, which they need to come up with because people in other parts of the world cannot afford a $60,000 US car. They can't afford it, which is going to impact their sales from a scale standpoint. Toyota has figured out how to make cars at a lot of different price points very inexpensively and get them to people all over the world, because pretty much in Asia, Toyota's a really heavy hitter, even though Honda's still a big heavy hitter along with Hyundai. So that's something they got to look at. But yeah, I think Toyota's debt is in the trillions. They got a massive amount of debt, but the volume's there. They actually are selling the cars. They've been doing it for a very, very long time. And there's still a lot of cash inside that company too. So Tesla's planning to be the Toyota. We got to see. Urban, they got to do the numbers. So let's see, can they do the numbers and what happens to that margin? Right? Because Elon was talking about that yesterday. He's worried about the margin because he knows that's what people are looking at. So if they can bring the numbers up, we're going to look to see what happens to the margin, because the issue is that if the margin starts to shrink, they may not be as attractive as a place for people to put their money. Because then you see what I'm saying? So if the margin, that return on equity, starts to go down, they may not be attractive as the numbers start to go up. So let's see, because they're not doing the numbers. If Tesla does 5 million cars a year, what does their margin look like? And we got to see once they get there. You know what I'm saying? Because they are a long way from Toyota. Toyota is a massive operation. Like the amount of cars they sell per year is ridiculous. I couldn't believe that actually that many people buy cars. So that's pretty much going to be it. Didn't want to be here long. Appreciate everybody for coming out. Apologize for the technical difficulties, even though if you got on late, you don't even know what I'm talking about right now from a technical issue. But I just want to encourage everybody. Start trying to forecast your trades ahead of time, because as a derivatives trader, if you can get in earlier, you don't have to pay the cost to get in the door with IV. So if you have to pay that, it doesn't mean the trade won't be profitable, but it won't be as profitable if you got in early. And so one thing I try to do is just constantly look at opportunities that I think are going to move before they move. So then I'm not stuck chasing the play, because I don't want to chase the play. Right? Because then if you chase the play and you're wrong, you're going to really pay for it. Right? So that's pretty much all I want to talk about. So I'm going to do this video series probably a few more times with a lot of different companies. We covered Beyond. Like I said, I think they're going bankrupt. Give them 12 to 24 months. They'll probably go out of business. We got a lot of other companies that we can look at that's going to be in that same scenario. And we also may look at companies on the upside. But what we're doing right now in this environment is we're getting ready to flush a lot of weak companies out of the market. Right? They're going to get flushed out. Then we're going to go into a new monetary situation, and you're going to get a rise of a lot of new companies with these same type of operation fundamentals. And then we're going to just start this cycle all over again, because we're just on the cycle. And we're just going to go through these cycles over and over again until we're no longer on the planet. So I appreciate everybody for coming through. David W. Williams, also known as Diamond Dave. I'll talk to you later.